Hey everybody, Marty Mazzura. Good evening. Second video for you today, December 19th, 2018. Just want to spend a minute on the Fed meeting today and then show you something as it relates to sectors that I think you should find interesting and instructive. As for the Fed, this morning I painted a picture that was actually pretty bullish. Short interest is very high, market very oversold, futures traders are getting more bullish on equities. Pretty much the perfect storm for stocks to go higher as long as the Fed gave the catalyst that was needed. When the announcement first came out, interestingly, the Dow was already up 300 points and it shot up another almost 100 points right on the announcement. Originally, it was viewed as a dovish hike, a quarter-point hike now, and less in terms of hikes in 2019 relative to what the Fed has been saying up till recently. Then when the market began to digest that they're still looking at 2 hikes next year, it began to sell off, got down to almost even on the day. Then, as I think traders were beginning to think about what Jerome Powell would say in his press conference, then the market started going higher again. Dow was up around 200 points at one point. Once he started talking, kind of vacillated all over the place until he got a question about the balance sheet. This would be all of the mortgage-backed securities and treasuries that the Fed purchased from the banks in order to rescue them during the 2008 recession. That balance sheet went from about $700 billion pre-recession to $4.8 trillion post-recession. Of the interest and principal payments that are coming in, $50 billion worth a month now, they're not reinvesting into new securities. $50 billion in the context of a 4.8, now about 4.4, $4.5 trillion portfolio is nothing remotely that should be considered dangerous tightening on the part of the Fed, particularly when we're still very much in expansion mode. But again, what the market was asking for is nothing that wasn't on balance dovish. And when he answered that question with, we're on autopilot there, we're not going to consider the balance sheet, we're going to manage monetary policy going forward just with interest rates, that sounded inflexible. Had he said, everything's on the table, including the balance sheet, I think the market would have exploded higher at that point. So he had an opportunity to help the market. I don't think he was thinking in terms of the market when he answered that question. I think he was being honest. But to be honest with you, and I don't want to be too critical because I think they're doing what probably should be done, I don't know that they need to be that inflexible on anything going forward. I think if a smarter commentary would have been simply, listen, we're not as aggressive as we were earlier because economic data is beginning to slow. The growth rates are beginning to slow. We're not looking at a recession, but we're looking at slower growth. So in a slower growth world, lower inflation than we anticipated, we don't have to have that tight a policy. Would have been easy. The market was ripe to go up on that. So now the smart money that continues to sit on the sidelines, and it looks like there's a lot of that, is really waiting for the green light to jump into what will be a sustainable trend in this continuing bull market. Thought we might get some of that today because I do think the trade issue is getting better. I think that that's going to be coming to a resolution within the next 2 or 3 months, or at least an agreement that feels like a resolution is in the offing. That I believe would be very bullish as long as general conditions continue to hold up. What we should really take away from the Fed is that general conditions are still pretty good. And the Fed's commentary pretty much mirrors our assessment of economic conditions, which means we are dealing with a very volatile period, but still within an ongoing expansion and an ongoing bull market. What we need to be wary of are these growth rates and the potential for the economy to roll over going forward, which would then demand that we get more conservative within our allocation. That's still not what we're dealing with, folks, despite the fact that this volatility can be nauseating if you're paying too much attention to it. Now, the chart in front of you is what's been going on sector by sector since October 3rd, which is about where the market rolled over or began to roll over into what is now about a 14% correction from the peak. 2016 was about 12.5%. 2011 for the S&P was 19.5%. Notice how utilities are up 4% during this period, while industrials are down 18, materials are down 14, and financials are down 15. I'm featuring those because those are the three largest target weightings within our portfolios. So our portfolios that are heavily exposed to equities just are not having a good go of it of late. The rotation to utilities says something about sentiment and about how the market feels about the economy going forward. So what you're hearing a lot of pundits say is that the market is a good barometer for the economy, and the market is saying we are on the verge of recession. And we are continuing to allow for our portfolios to be exposed to areas pretty much in the face of the signals the market itself is sending. So let's go ahead and kind of test that theory, the market's ability to forecast the economy. And let's do that by going back to that 2016 dramatic, painful correction that we experienced. Much like today, utilities were up almost 6%, industrials were down just about 10%, materials were down 13%, and financials were down 17%. So big declines in the sectors that we happen to be most exposed to today. This is clearly a signal. The market is saying that the probabilities of a recession going forward were definitely greater than the probabilities of a continued expansion. So let's look what actually transpired from that bottom there on February 10th, 2016 to December 31st of that year. So what a rebound. Actually, utilities at that point are still up 4%, but that means they were down 1%. Industrials rebounded hugely, up 25%, materials up 25%, and financials up 41%. All three of our biggest weightings today, notably outperforming the S&P 500 at the time. Our index and our assessment of economic conditions at the time was still positive. When I back test our index to the bottom, to that February 10th date, it scored an 18. This last weekend, it scored a 26. So we're in that neighborhood. It's not a real high score, but it is a score that says that the weight of the economic evidence says that this is still an ongoing expansion. You can see how dangerous it can be to react to the wind, if you will, react to the volatility and go against the underlying tide, so to speak. The underlying tide, the underlying momentum is still expansionary. The volatility, the wind that's right in our face is what we're seeing in terms of this correction. We will continue to keep our fingers on the pulse of the data and act accordingly. Thank you as always for watching and listening. I'll be back soon with more. Take care. Bye-bye.